Dear value investors, welcome back to a new episode of 36 Square Capital, a value investor channel. Remember that good investors read and understand the financial statements of the company they have invested into. In this episode, we'll be practicing our capacity to read financial statements by looking at German real estate company Vonovia and their 2021 annual financial report. If you like the channel, do not forget to subscribe and hit the notification bell. Let's get started. So the first thing to discuss, and I'm going to ask a couple of questions, I'll try to make it also with you as well interactive, is first of all, I will want to share with you how I look at financial statements when I have to analyze a company. And in fact, here what is pretty interesting is that I came across Vonovia because my best friend Adriano told me, Kenny, what do you think about Vonovia? He did the valuation and he wanted to have my perspective on that. So by the way, thanks for that. And I want to share with you how I look at those financial statements, as I just said. So the first question I'm going to ask you is, what kind of, or which report shows the variation in wealth year over year for companies? So remember that company, typically they provide three types of financial reports: the balance sheet, the income statement, and the cash flow statement. There are two other ones, like the other comprehensive income, for example, the changes in equity, but we will only be looking at balance sheet, income statement, and cash flow statement. So from those three, which report shows the variation in wealth year over year? So I'm going to pause here, maybe pause the video 1 second and try to answer if you have the answer. For those who would not know, it's the balance sheet. So the balance sheet, and that's a characteristic that is very specific to the balance sheet. The balance sheet is the only financial report that shows you the accumulation of wealth or the stock of wealth of the company that you're investigating since its day one, since the inception of the company. That's something that the income statement and the cash flow statement do not have. They only look at a certain period of time. Typically, you're going to have quarterly income statement, yearly income statements. Sometimes in Europe, you're going to have semestrial income statement and cash flow statements. But the balance sheet, at any moment in time, even you would ask your CFO to provide a balance sheet. The balance sheet shows what happened to the company since day one, since the creation of the company. Second question I want to ask you before we go deeper into the Vonovia case is, which report shows how the money has been employed? So what are the inflows and outflows of money? So pause the video maybe here, give it a thought. And so the right answer to that question is the cash flow statement. And why I'm asking those two questions in the beginning is because I want you to see how I read and how I analyze financial companies or companies with their financial statements. So here, in fact, and looking at Vonovia, and I've put the URL here where you can go on the investor relations site of Vonovia and download the reports I'm looking into here. So in fact, and that may seem weird because 95% of the people, when they look, even Wall Street analysts, they very often look at the income statement first. And I will not say that I'm not interested in the income statement, but when I have to analyze a company, I very often look and I like to start with the balance sheet. And this is exactly what I did on Vonovia. And this may sound weird to start with the balance sheet statement. And you're going to see, I'll build this up. I'm going to ask a couple of further questions. So you have here the balance sheet, and maybe download the document and have a look at it for yourself. And the balance sheet here of Vonovia is showing the position, the financial position, consolidated, including all subsidiaries, between 2020 and 2021, so for the full fiscal year 2021, but you also have a comparison with the closing balance sheet of 2020. So another question to you, because again, as I'm training my students as well, is to become fluent in looking and reading those financial statements, is on the left-hand side you have the assets, on the right-hand side you have the capital bringers, the sources of capital, if it is equity bringers or debt bringers. And so on the left-hand side you see that the current assets come after the non-current assets. And I asked this last Saturday during the webinar, because we did this also during a live webinar for the students. The question is to you, why are the current assets in the balance sheet listed after the non-current assets? Again, pause here, try to find out. The answer is very easy. Again, I'm not doing things here that are rocket science. So the answer is because it's an IFRS statement. For those who would not know, but the companies, let's say nearly all the listed companies in the world follow IFRS reporting, while US listed companies, they do follow US GAAP, so US generally accepted accounting principles. And one of the differences in terms of, let's say, how the information is presented in the balance sheet is that if it is the assets, but also the equities and liabilities, in IFRS, you're going to have the long-term, let's say, assets and the long-term liabilities and the shareholders that come first before the short-term, so before the current assets and the current liabilities. In the US GAAP, it's the other way around. It always starts with the short-term assets, the short-term, so the current liabilities, and it goes down then to non-current liabilities and to the equity holders at the very end. And on the assets, it goes down with the most illiquid assets on the left-hand side in the US GAAP balance sheet. So just be aware. At the end of the day, it's I would say that is not important. It is important, but you need to be able to see that this is an IFRS report and not a US GAAP report. Now, the main piece of thing that will bring us into analyzing what happened to Vonovia in the year 2021 is I want you to look into the big figures that are in the balance sheet. And more specifically, I want you to analyze and comment the big differences year over year. So I want you to be able to read the 2021 end position of a category, maybe an asset category, a liability category. We're going to start with the asset side. And I want you to be able to understand and see what has happened and do the interpretation of what has happened on that. So maybe pause here, have a look at the asset and the equity and liability side, and try to understand what were the big changes. Now, after having paused, so let's assume that we are resuming here the video, and I'm going to walk you through what were the big differences. When I look at such a balance sheet, and this is what I did for Vonovia, the first thing I did is I looked at the total of the balance sheet to understand what was the difference year over year. And remember, a balance sheet is balanced. So I was looking at the total, and I've put it here in red, in the red frame. So you see that the total amount of assets, but also of liabilities, has increased from 62 billion euros to 106 billion euros. So that's already a first material change in the balance sheet. That's really substantial. And if you do the math, so the company has been adding, according to this financial statement, has been adding 43.9 billion euros in terms of assets. So that's a 70% year-over-year variation. And when how do you interpret this? So my first reaction was like, okay, but wait, I have to look at the income statement and see what is the typical profits that they do for the year. And if you look at the income statement, they do let's say 3 billion euro profits year over year. So the increase in the balance sheet year over year between 2020 and 2021 is not coming from the profits of the fiscal year 2020. So without going even further, when I saw this, I immediately said, this is something happened that is not typical for the company here, because you do not add 70% year over year on the asset side, on the liability side. Very probably if you have not changed your scope of business. So I went deeper into it, and you're gonna see, just by looking at the balance sheet, I started to create some assumptions in my mind when analyzing Vonovia. So staying on the left-hand side on the assets. So again, my question was to you, what were the big differences between 2020 and 2021 in the balance sheet? And remember, the balance sheet shows the accumulation, the stock of wealth since creation of the company. So you're able to compare variations year over year. So I felt that, so we have this rough cut 44 billion euro change in assets, and you need to take into account that Vonovia is a real estate company. So I looked into, well, first of all, on the subcategories, current assets versus non-current assets. And if you look at the non-current assets, you see immediately that the company has added nearly 40 billion euros into the non-current assets, so from 60 to 99.5 billion euros. And if you go even into a subcategory of the non-current assets, you see, and one of the students Saturday mentioned that as well, is you can see that the investment properties, so that's bullet point number 2 here in the red frames, you see that the investment properties have been growing from 58 to 94.1 billion euros. So that was already for me a signal that something had changed in the business scope of Vonovia year over year. I could not already state that it was maybe an acquisition they did, but it started to give me a gut feeling that maybe they did an acquisition of another company and this company was now consolidated in the balance sheet, which was not the case in 2020, which explains just on the investment properties such a huge difference of 36 billion euros on those long-term assets. What happened as well, I mean, we can go into bullet number 3. The intangible assets have grown by 1.4 billion from 1.6 to 3 billion euros. That was another, I will say, kind of confirmation, because typically in intangible assets, you're going to have trademarks, intellectual property, patent rights, those kind of things, but also goodwill. So goodwill, I mean, if you do not know, but goodwill is the premium that you pay on top of an acquisition. So imagine that the company has, or I'll take the following example. I'll take an example with Facebook and Instagram. Before Facebook bought Instagram, let's imagine, it's just an assumption, the figures are now just here purely for the example, theoretical. Let's imagine that Instagram had a balance sheet of $1 billion US. Facebook, at the moment of an acquisition, in order to be able to acquire 100% of Instagram, maybe they put 2 billion on the table. I think the figures were bigger, but just for the sake of the example. How does Facebook, when they consolidated Instagram into the balance sheet, how do they report the 2 billion that they spent, while the balance sheet of Instagram was only worth 1 billion? The difference between the two, that's the goodwill. So the premium that Facebook paid, in fact, on top of the balance sheet, on the fair valuation of the balance sheet of Instagram, that's called the goodwill. So when I saw this coming back to Vonovia, even though Vonovia is not a tech company, tech companies have normally very big positions in terms of intangible assets, and even goodwill, even sometimes the goodwill is listed separately. But here I was like, okay, I mean, intangible assets going up by 1.4 billion, so nearly multiplied by 2 versus the previous year, plus investment properties going up. I was like, that's maybe a goodwill that came into the intangible assets as well as something else. So that's again a typical change of scope, except if they did an accounting treatment change, so that they changed the rules how they were accounting things. But that's something that you can find out in the financial report when you read the financial report. What else did we have? So we have a couple of financial assets that have changed. So we see the long-term financial assets at 1 billion, the short-term also from 0 to 1 billion. Cash equivalents, also went up a little bit. And then we had also assets held for sale that are at 2.7 billion. So that's, just to make it clear, assets held for sale are assets that were maybe long-term assets that have been moved into short-term assets because there is an intention that those assets will be liquidated over the next 12 months, so over the next fiscal year. That's why they have been moving there. So basically what we see here, just by looking at the balance sheet, we see an increase in intangible assets that could be goodwill. We see a huge increase in investment properties. That was giving me the signal that something has changed in terms of scope of business. And then also the assets held for sale, that's just a reclassification. So probably they were last year in the investment properties and now they have moved or been reclassified in the assets held for sale. So that's interesting to understand from an asset perspective. So those assets, remember how it works with the balance sheet. The assets of the company are there to generate income, to generate profits, right? That's what at the very end of the day is called the return on invested capital. So it's the total amount of assets minus the cash, that's return on invested capital, and you can calculate the profitability on that. Now what we need to understand, remember how a balance sheet works, is on the left hand side you have the assets, but you have to bring in capital to finance those assets. And we want to now, and I'm going to ask you the same question, what has changed? What are the big differences between 2020 and 2021? We have understood on the asset side, but now I want you to look at the equity and liability side. So pause here the video, maybe have a look at the balance sheet, so the right hand side, so the capital sources. And remember there are two types of capital sources, the debt bringers and the equity bringers, so the debt holders and the shareholders in fact. So let's start with the from the bottom to the top. We're going to start with the debt holders. So in fact, what you see, and that's the bullet point number 2 in the red frame on the right hand side, you see in the current liabilities and the non-current liabilities, you see the non-derivative financial liabilities that have been hugely increasing. So the current ones have been increasing by 5 billion, and the long-term financial liabilities have been increasing by, that's around 18 billion euros from what I see here. So, I mean, that's rough cut 23 billion euros of increase. And remember, the balance sheet has increased by 43, so half of the increase of the balance sheet is coming through non-derivative financial liabilities. What is this? Well, this was already telling me very probably they made an acquisition which has hugely increased the amount of assets in terms of investment properties, and a big portion of how they were able to finance that acquisition is coming from printing corporate obligations. That's here they call it non-derivative financial liabilities. Some that are short-term, so that's the current part, the bottom part, so the 6.8 billion, and some that are longer term, that's the 40 billion euro that are part of the non-current liabilities. So that's like half of the increase has been financed through debt, new debt, which obviously has an impact. I mean, if you look afterwards into the performance of the company, you remember that as a value investor, we look as well into the amount of debt that the company carries versus equity. So potentially or very probably the debt to equity ratio has evolved versus how it was last year. And it's the case. I mean, if you look at the total amount of liabilities, last year it was 37 billion versus 24 billion of equity. So it was a ratio of what, 1.4 rough cut debt to equity, while now this year in 2021, total liabilities are sitting at close to 70 billion, so 69.7 billion of liabilities, total liabilities, current and non-current, and equity is sitting at 36. So we are close to a debt to equity ratio of 2. So the company has taken up supplemental debt to finance. We're going to see later on this change in scope of business. What else has happened? We do see in bullet point number 3, we do see that non-controlling interests have increased as well. So those are companies that are consolidated in the balance sheet of Vonovia but are not 100% owned. So you have some still external shareholders that are sitting on the non-controlling interest. What has changed as well, very important, capital reserves. So that's, I forgot to mention, as it's in fact my first point on the balance sheet. So the capital reserves have grown from 9 billion to 15.4 billion. So rough cuts, let's say a little bit more than 5 billion or let's say 6 billion euros have been brought in through fresh capital. Again, if you're able to understand how a balance sheet works and how financing works, when capital reserve increases, it means that the shareholders have been bringing in fresh money, not debt holders. So here we see already, just by looking at the balance sheet, and I've not even looked at the financial report, just by understanding the big differences year over year, that we have very probably a change in scope of business. Remember the investment property change on the left hand side in the asset side of the balance sheet of 2021 versus 2020. And we see that 6.5 billion came from an increase of fresh money coming in from the shareholders, and we have 23 billion that are coming from debt sources. So from the 44 billion change in the balance sheet, rough cut 30 billion are coming by financing sources, which are shareholders, 6.5 billion, and 23 billion of debt holders, probably corporate obligations. What else has changed? Retained earnings, so they have increased from 13 to 16.9, so that's probably they have kept most of the earnings from last year. So this is also a source of financing, so the income of the previous year. You're going to see later on in the income statement that they typically have a profit of around 3 billion euros on their assets. And then we have something which is also interesting, which is the deferred tax liabilities. So they have grown also by nearly 8 billion euros. To be very fair, I did not look into the details what has happened, but there has been probably something happening where they have increased the debt well, at least the debt that they have to pay back to tax authorities. And so they probably have, let's say, cashed in something, but on that cash in there is a certain liability, and it has increased by 8 billion versus the previous year. So rough cut, when I was looking into this, I didn't even look at the cash flow statement and the income statement. It was like, it looks like there's a change in scope of business, and I have understood where the money came to finance that change in scope of business very probably, which was a mix of debt, so 23 billion versus also new money that came in through an increase in the capital reserves of 6 billion rough cuts by the existing or maybe potentially new shareholders. Okay, so that's for the balance sheet. So again, maybe pause here, go back, but that's how I look at, for example, when I do such an analysis, like what happened to the balance sheet? Because the balance sheet shows the accumulation of wealth since day one, and also it shows you can see the differences year over year. That's pretty interesting. So the second thing is very important. You may have heard already that a lot of people say cash is king, etc. But I indeed like to look at cash. I look at the income statement nearly at the very end, which may feel weird because 95% of the people, they start with the income statement, and then maybe they go into cash flow and balance sheet. But I mean, a lot of, even the press, when they analyze companies, or they always speak about the earnings per share. So that's income statement related metrics. And I mean, as a value investor, it's not necessarily my style. I like to understand what happened to the company, so to the assets that are there, to the debts versus the equity, and then what the company has been doing in terms of cash management. So what was the employment of cash in the last year? So let's look at the cash flow statement. So exactly the same question, and you see it's not rocket science. What I want you to look into here in the cash flow statement, and remember that the cash flow statement is divided in three things. You have the operating cash flow, that's always the first one. If it is IFRS or US GAAP, it's always the same. You have the investing one, and you have the financing one. Do remember as well, and I'll make it simple, that the cash flow from operating activity is the cash flow that is either generated or consumed by operational activities, which are, let's say, in the cycle that we are analyzing. And that's why here in the cash flow statement, we're looking at an annual cash flow statement. So it shows how the inflows and outflows of cash were between January 1st, 2021 and December 31st, 2021. After the cash flow from operating activity, and I mean, the minimum, the typical average should be that the cash flow from operational activities should be positive, but it happens that sometimes even that cash flow from operating activity is negative. The second cash flow that you have, and you need to understand that investing activities, even though you're looking at them on a yearly basis, when you have, for example, an outflow of cash in the investing activity, it probably means that the company has been buying an asset that will generate operational cash flow over, let's say, maybe the next 5 years, the next 10 years. We're going to be analyzing this. And then when those two cash flows are done, you have the cash flow from financing, which is the one that is being used to either pay back debt holders or give a return to shareholders. But let's start with the big differences, and that's the analysis I want you to do. So the first big difference that you see is in the cash flow from investing activity, because if you look at the operating, it's rough cut, it's the same. It's 1.4 billion euros of positive cash flow from operations versus 1.8 billion in 2021 from operations. And you see it here in the slide, in the frame with the dots with the point number 1. You see that there is a category in the cash flow from investing activity, which is payments for acquisition of shares in consolidated companies in due consideration of liquid funds. So what does this mean, to make it simple? The company has spent 17 billion euros in acquiring shares. So basically, what is a share? A share is a portion of the balance sheet. So the company has been acquiring shares of other companies that are now consolidated in the balance sheet of Vonovia. This thing, after having analyzed the balance sheet, was clearly confirming to me, okay, they did an acquisition. Now it's 100% clear, because I do see that 17 billion have been used to do this acquisition. That's what the cash flow from investing is telling me. In frame number 2, on the right hand side, in the financing activity cash flow, we do see that they had And I want to discuss the two lines, so the 23.9 billion, which is the proceeds from issuing financial liabilities, and the minus 11.5, which is the cash repayment of financial liabilities. So you see that, I mean, the changes are big compared to the previous year. Last year they had like 4 billion of issuance and minus 3.7 of cash repayment. So first of all, what is this category? What are those two lines, and are they linked together? Yes or no? Well, yes, they are linked together. The first line, a proceed from issuing financial liability, is in fact an inflow because a company has created a new debt instrument, like a corporate obligation. Probably, I'm not sure if there's a zero coupon or if there is an interest rate linked to it, but very probably there's going to be an interest rate linked to their credit rating that is linked to it. So a proceed is an inflow of cash. And here we see that in 2021 they had nearly 24 billion of cash inflows by let's say, creating those corporate obligations. Here in the cash flow, we are looking at 1 year. It does not tell you what is the duration, what is the interest rate. For that, you need to look at the financial report. But I see that they had a huge inflow of cash by raising debt, in fact. Cash repayment of financial liability is the other way around. It's an outflow to those debt holders. So we are, in fact, neutralizing existing debts. But it's interesting to see compared to 2020, where they had like a 3.7 billion outflow of cash because they have been repaying debt holders, so probably corporate obligations. In 2021, there was an outflow of cash of 11.5 billion. So they had to pay back 11.5 billion, very probably of debt holders linked to corporate obligations. That's a big amount. And then we have in the third bullet point where we have an line in the cash flow from financing activity, which is a capital contribution on the issue of new shares, including premium. And here we have a 7 billion difference versus last year. So what does this line mean? And remember, we saw this in the balance sheet. We saw the capital reserves increasing by, what was it, rough cut, 6.5 billion euros, something like this. So here what we have, and that's why they mentioned include premium. In fact, the difference of 6.5 billion is here, and probably there is 500 million, so 500 million that are the premium that they gave to the shareholders. And I'm going to explain the issuance of new shares again a little bit later on, but I want to already touch upon this here in a couple of seconds. So the point is the following. The cash flow here from financing is telling me they did not provide, on this line, they did not provide a return to the shareholders by doing share buybacks. At least we don't see it in the cash flow from financing. But they have been asking shareholders, either existing shareholders, and this is where the premium, we're going to discuss the premium later on, or new shareholders to bring in fresh capital. That's the 6.5 billion increase that you saw in the capital reserve. Here we have a 7 billion difference, so 500 million is that premium. So that's the incentive that they gave to the shareholders to buy those shares. So we see, and I mean, when you raise fresh capital from existing or new shareholders, that's an inflow of cash that you can employ to buy new assets, and probably they employed that money to purchase that 17 billion of investment properties. Okay, so here we have the big differences. I think that's for the cash flow statement. I think that's the main things that you have to understand is those three things. We clearly have now confirmation there has been acquisition of a company, or at least of a lot of assets, and that the company is now consolidated. That's point number one. Point number two, they have raised fresh money by raising the amount of debt, and they have raised fresh money that we already saw in the capital reserve difference in the balance sheet year over year. We clearly see it here in the inflow, so they call it the capital contribution by the issuance of new shares from existing or new shareholders, including the premium, which is the difference between the purchase price and the, let's say, the price that the share has been indeed valued. All right, so now, one thing that I want you as an investor to try to interpret, it's not just about understanding the big differences. So we did the interpretation on what we felt has been a change year over year, an acquisition of a company, and we see how this acquisition has been financed. Now I want you to think, but wait a second, if the company has been issuing new shares, how do I as an investor react to that? And that's something that we're going to discuss about equity dilution now. That's something that is very important for value investors, for existing shareholders to understand. And let me try to explain it here. I mean, when the effect of equity dilution happens, and specifically here, the company has been printing out of thin air new shares, existing shareholders get diluted. So if, for example, they had imagine you have 10 shares of a company that has 100 shares, and the company is and with that you have 10% of the equities, or your stake in terms of equity in that company is of 10%, so 10 shares out of a total of 100 shares. If the company decides to print out of thin air 100 new shares, the total amount of shares is now 200, and if you are only sticking to your 10 shares, your equity stake has been diluted from 10% to 5%, because now you only own 10 shares that were the 10 that you had before equity dilution, so before the issuance of new shares, but now you have 10 shares out of 200 shares, that's 5%. Prior to the issuance of new shares, you had 10 of 100 shares, out of 100 shares, so you had 10% equity stake. How did I find that out? Of course, it's mentioned in the financial report, but I'm gonna show you a very quick way of looking into it. And that's that's what Wall Street likes a lot. They always speak about, and the analysts and a lot of friends and circles speak about earnings per share, this famous EPS ratio. And what is interesting, looking at the income statement, is that Vonovia has been indeed, of course, showing they have to present the income statement, and they already calculate the earnings per share. So let's have a look at the income statement, and you're going to understand where I'm going down. So when you look at the income statement, you see at the very bottom line that the earnings per share in 2020 were at 5.50, and in 2021 they were at 4.22. Okay, that's not necessarily good. I mean, analysts would tell you, oh, that's not good. I mean, earnings per share have gone down by 15 to 20% year over year. Okay. What we have to look into is the profit for the period as well. So the profit for the period, so the net income after taxes, has been of 3,340,000,000 in 2020 and 2,830,000,000 for 2021. So indeed, they have lost they made less profits versus last year, but they still made a profit of 2.8 billion, which is, it's reasonable. So in order to, what I want to show you is a quick way of looking if equity dilution has happened. And let me do the math here. So if you look at the earnings ratio year over year, you have the 2,830,000,000, you divide that by the previous year, and you see, in fact, that the earnings have gone down by 16%. So it will tell you that 2,830,000,000 is, in fact, 16% below 3,340,000,000. Okay. But when you do the same calculation for the EPS ratio, you take 4.22 and you divide it by 550, it is giving you an EPS ratio of 0.76. But wait a second, normally the earnings of this year divided by the earnings of last year is one ratio, and the earnings per share of this year divided by the earnings per share of last year should be the same ratio, but it's not the case here. And this was clearly telling me there has been equity dilution that has happened here. And I'm going to show you how to calculate this very quickly without even having to read the annual report. So let's take the following assumption. If in 2020 the total net income after taxes of the company has been of 3,340,000,000, and so you have to divide this amount by the total number of shares to end up at 550. So what we are missing is this value. By how much do I need to divide 3,340 to end up at 550 earnings per share? The answer is, to the math, is 3,340 divided by 607 million of shares outstanding. That is giving you the ratio of 550. If you do so, and we are considering here that, as we do not know, that normally equity dilution has not happened. So if you would divide the 2021 figure by the same amount of shares of 607 million shares, you should be landing at 4.66 euros per share. But the fact is that you're ending up at 4.22 euros per share in terms of earnings per share, sorry. So what does it mean? This clearly shows the equity dilution effect, because it means that the profit of 2021 has been divided by a higher number than 607 million of outstanding shares to end up at 4.22. By how much? Well, you can do the math. In fact, you do the calculation between the 4.22 versus 466, and you see that has been a 10% equity dilution effect. So the amount of shares has indeed increased by a lot, by 10% compared to last year. Now, and you see this, I've put you the screenshot. On page 183, they speak about it. They are saying, yeah, be attentive, earnings per share are calculated, and we did a share increase. And they're bringing in the numbers. And so they're calculating the weighted average number of shares between 2020 and 2021. And we indeed see that there has been a rough cut at 10% equity dilution. So we're speaking about equity dilution. Equity dilution means that new shares have been created out of thin air by the company to bring in fresh money. And so it means that normally, and I just want to pause here 1 second, how does that process work? I mean, it's a regulated process. So the company typically has to, I'm going to call it, issue a prospectus. That prospectus will indeed carry a certain amount of information, who is taking care of this, the amount of shares, and very important as well, so from when to when the subscription offer runs, and also what is the subscription price. And I've put here the URL, and you see in fact that the subscription price indeed is of 40 euros for a new share, and it has to be latest paid in by December 7, 2021. So what you need to understand, if you would have been an existing shareholder before this issuance of new shares, is how can you avoid this equity dilution effect? So remember, I was taking this very simple example. You own 10% of a company that has 100 shares, so you own 10 shares. The company has decided to raise fresh money. You cannot go against that decision. The company multiplies by 2 the amount of outstanding shares, and now you have the company who has 200 outstanding shares, and you only have 10. Your equity has been diluted from 10% to 5%. How can you avoid this? Well, there are a couple of means of avoiding this. First of all, you can vote if you have voting power against such a decision, because issuing new shares is not something that management can decide by themselves. Typically, it goes through the board of directors. This is a typical reserved matter for board of directors, where they can then decide yes or no to do this. But typically, even very often, the board of directors cannot decide this alone. It's the shareholders who have to decide on this. And this is where the shareholder agreement comes into play. I will not speak about this here because it would really take us too much time and too far away from the conversation of Vonovia. But imagine that, I mean, if you are a minority shareholder and you own 0.001% of the company, I mean, you will be alone unable to vote against such a equity dilution subscription offer, so printing of new shares. But if you own 51% of the company, well, maybe the shareholder agreement says that you need majority vote of the shareholders to raise the amount of capital of the company by printing new shares. So then maybe you're in a position to do this without even having to think about the other 49% of the voters. In very large companies like Vonovia, I mean, I have not looked into the details who are shareholders of Vonovia, but very typically, if it is not a family-owned company and there is a lot of free float out there, you're going to have such a resolution that will be presented to the annual shareholder meeting, to the General Assembly, and then the shareholders will vote for or against this. So probably if this happened, it means that it has been agreed. I mean, for sure it has been agreed by the annual shareholder meeting, but you would need to understand how many shareholders have voted for it, against it, and how diluted is the equity, how many small shareholders are there versus big institutional shareholders and investors. But all in all, we clearly see that there has been fresh capital that has been raised and there has been a subscription offer. And this is also where the premium comes into play, because maybe, I mean, you have seen that rough cut in the balance sheet. There has been an increase of 6.5 billion, but the company has spent rough cut 7 billion. So this $500 million difference is a premium. So probably, and this is how they can give an incentive to the shareholders to vote for it, is that the CEO, and I'm not saying now this for Vonovia, but generally speaking, what can happen is that the CEO says, yeah, I mean, I understand that you are unhappy because your equity will be diluted, but if you buy this new shares, so you have to spend this new amount of money, and I will come to this in a second, we're giving you a premium. So maybe you would have to pay, let's say, 50 euros. We're giving you a new share at a discount price of 40 euros. So the 10 euros, that's a premium that we are taking into account. We are absorbing this for the company financials. You don't have to pay for that. But what does it mean? It means that if you as a shareholder, if you do not have the capacity to spend fresh money, your equity will be diluted. So the book value of one single share is going down with that. And that's something that you not necessarily are happy about as a shareholder. I would not be happy about it. But in order to avoid further equity dilution of my stake in the company, I would need to bring in new cash and be able to spend new amount, at least 40 euros per share. I would need to spend this amount, but maybe I don't have cash available, so my equity would be diluted. And that's not necessarily something that, I mean, I hate equity dilution in general in mature companies. I'm not speaking now about startups and in venture capital and private equity. This is typical before the IPO, but after IPO, I mean, I'm not always very happy when I hear, or at least I'm raising a lot of questions when I look at equity dilution mechanisms. And that's the thing that you need to understand as a potential existing shareholder before this equity dilution happened, is that if you're unable to bring in this fresh cash, your book value per share will go down, in fact, and so you're losing in terms of value, even though the company decides to create new shares. But the promise that they're giving you is, with those new shares, we are financing and with this fresh money that is coming in through debt, but also here through equity holders, we are financing the purchase of new assets, and those new assets will generate more profits in the future. Hence, your earnings per share will go up, even though we have diluted the amount of earnings per share because we are printing out new shares. And I wanted to look here, stating this, it may feel, and I'm not saying that all equity dilution mechanisms are bad, because what I just stated is that the CEO or the board of directors is telling you, by allowing us to print out new shares and bringing in fresh cash, we're going to increase the profitability of the company. And I looked into Morningstar, and I looked into what's the track record of Vonovia, because normally, first of all, is this equity dilution a one-time effect, or is it constant that they do this kind of thing? And when you look at the right frame at the bottom, according to Morningstar, and indeed, if you look at it in the balance sheet, indeed, it's a practice of Vonovia of diluting the equity year over year, and you see that the diluted amount of shares outstanding has increased. In 2016, it was at 584 million shares, and now it's rough cut at least at the end of 2021, at 735 million of shares. Just make the math between the two. That's rough cut 20% difference between the two. So it means that if you were a shareholder in 2016 and if you were unable to buy new shares, and this happened every year at Vonovia, if you're unable to buy new shares, your equity of 2016 has been diluted by 20%. So the value of the shares the book value of the shares has been going down by 20%. So you need to be able, if you would invest into Vonovia, and again, it's not a solicitation for you neither to buy nor to sell Vonovia, I'm just trying to share educational content here. But if I would be the investor, if I would decide that Vonovia would be a good buying decision, let's take that for an assumption for 1 second, and we need to do the full intrinsic value calculation. But still, I would then, in my investment strategy, have to think that every year I need to have at least 5% of cash available of the amount invested in order to avoid equity dilution. But then, and this is what I was kind of promising if I would be the CEO, is like the total amount of earnings should go up by printing new shares and bringing new assets into the balance sheet. Is that the case? Well, just look at the net income available to common stockholders. If you do the average, with the exception of 2020, it's not so big. It feels like it's pretty organic or flat. It's positive, which is very good for the company. The company has a track record in let's say, in printing profits. But nonetheless, you see it's like 2.3 billion, 2.4 billion, 2.2 billion, 1.1 billion, 3.2 billion in 2020, and 2.6 billion in 2021. Those are, let's say, absolute figures. Of course, now what we want to have is in 2022, as the balance sheet of the company has increased by 70%, could we expect an increase in 70% of the net profit after taxes of the company? Well, the logic would expect, the normal thought process would expect that yes, this should be the case. And if not, it's even worse, because the company has been spending a lot, has been spending the return that you get on one single share, so the earnings per share. And so normally, I mean, if the total net income is not going up, I mean, that's very probably money that has not been employed correctly. And how do you see this very quickly? Just calculate the return on invested capital. Invested capital has gone up with new debt, new capital brought in the capital reserves. If the profit remains flat, so the income on assets minus cash and cash equivalents divided by the total sources of capital, which is debt and capital, that's ROIC. Well, if the ROIC has gone down, the company has destroyed value towards its shareholders. And there, indeed, you should not be happy as a shareholder. I'm not stating now this for Vonovia. I have not looked into the 2022. Maybe I'm gonna do a future YouTube video or lesson about this. What happened in 2022 after the equity dilution and after buying all those assets. And what has to be done is, of course, as I said, never, and Peter Lynch is stating this, I'm speaking about this really a lot in my trainings as well, do not invest into companies just by looking at one or two ratios. I mean, you have to do a full intrinsic value calculation, and there are at least 10 to 15 tests that have to be done to give you a reasonable estimation if it is a sound investment or not, and if the market is undervaluing the company or not. And what are the expected returns that you can have as a shareholder based on cash dividends, share buybacks, those kind of things. So, I mean, I cannot do this in this YouTube video, but I mean, for those who have done the training, please do the intrinsic value, use the intrinsic value calculation sheet, the Excel file that is attached to the other value investing training. Do the math and try to estimate what the company is worth and comparing it with the current share price. There is one thing that I'm going to solve immediately here, and I want to make it short for the sake of as it is just an educational video, and we have been extensively discussing this in the last webinar, is that a typical, I mean, everybody that I talked to did the following mistake. So we have seen that there has been an acquisition, and I'm putting this explicitly here when you go to the pages 160 and beyond, specifically the page 163 in the annual report of 2021, we do see that Vonovia acquired Deutsche Wohnen Group. So they indeed acquired another company, and it has been, if I'm not mistaken, it has been a pretty hostile takeover, so it was not necessarily a friendly one. And we do see, and that's very friendly of Vonovia's management, that they are making, and you see this in the red frame, that they're making the following statement. They say that starting December 30th, 2021, that Deutsche Wohnen Group has contributed to 971 million euros in terms of income and 262.9 million euros in terms of profit. And so what? Let's stop just 1 second here. What does this mean? It means very probably that the income of Vonovia has increased by those amounts and the revenues as well, but only starting September 30th. So it means that in the income we only see currently October, November, December 2021. What does this mean as well is that when you do the valuation, and this is the mistake that people did, they did not calculate the fact that they had to adjust the total revenue for the year and the total net income on a 12-month basis, because you cannot use those amounts. So you have to remove those amounts and calculate those amounts on a full year. And this is, in fact, you do not even have to calculate it. Vonovia management, and that's positive, is very kind, because they're telling us it's just a paragraph below. And this is where you see that by not reading the financial report, you may miss a very important aspect on how to do the valuation of the company, because this is all about at the very end. You want to be able to value those assets and understand if the market is giving you a share price that is cheap and it's an opportunity for you to buy the company or not, in order to have a capital gain later on. And in the paragraph below, it states if the Deutsche Wohnen Group had already been fully included in the consolidated group as of January 1st, 2021. So again, they confirmed that it has only been consolidated from September 30th on, so for 3 months. The income and the profits would have been of, so the revenue would have been of 2.3 billion euros and the profits of 1 billion. And this is not in the income statement, and this is something that you need to take into account. While the balance sheet is fully consolidated, so all the assets are there, the income statement is in fact not taking into account, or is only taking into account October, November, December, so the last quarter of the year in terms of revenues and profits. So you need to make this adjustment to do the evaluation. I will not go beyond into this, but that's the typical mistake everybody came across. Is like when I asked them, please do the valuation, they took the numbers that were there in the income statement and they did not read the financial report, and they missed in fact that they could have, I mean by only taking a quarter, they in fact undervalued by nearly 20, a little bit more than 20%, they undervalued the company, which is not good. They should have taken 12 full months estimated of revenues, which is basically what Vonovia management is giving us here, and bringing this into the intrinsic value calculation sheet, and by that you would have seen that the intrinsic value calculation would grow by more than 20 euros per share. So so that's the kind of thing. It may feel or sound complex, but guys, that's the reality of doing valuation. It is, first of all, it's an art because human judgment is required. And but you need to be able to have those keys to read financial reports. And I hope that's, and we're gonna wrap here, I hope that with this video that you see, first of all, how I analyze very quickly. I try to be laser sharp because even the Vonovia report was like 300 pages. I did not read all the 300 pages, sorry. And I really tried to understand, just by looking at the financial reports, what was going on. And I was able to reverse engineer, at least I think, with all humility, without, I don't want to come across as arrogant, with all humility, I think I was very quickly able to understand there has been a change in the scope of business. I didn't know yet when I was seeing that it was Deutsche Wohnen Group. I then saw that the sources of financing had increased between debt and equity. I was like, okay, equity, increase in equity means equity dilution. That's not necessarily good, so I need to look into that as well. And then indeed I searched in the report for the term acquisition, and I found out that indeed they acquired Deutsche Wohnen. So rough cut, that was giving me what I needed to understand from a business perspective, what happened between 2020 and 2021. And then, of course, I mean, I do not invest into real estate because it's not my investment universe. I'm speaking about this in my trainings. I do not feel comfortable investing into real estate, but as my best friend was asking me what was my feeling about Vonovia, I made the exercise, and I make the exercise of valuation. And this is where as well I thought it would be interesting to share with you guys that when you do the intrinsic valuation through the calculation sheet, so the Excel file, that you should not forget to do it on a 12-month basis and not only on the last quarter. So with that, I hope that it was interesting, useful. Of course, it was accounting related this time, so less, let's say, strategy market oriented. So the next one will be a little bit softer. And do not forget, I mean, if you are on YouTube, that I'm giving those trainings on all well-known learning platforms. If it is Thinkific, Skill Success, Skillshare, Udemy, and the links to the training platforms, you can find them by going on my website, 36squarecapital.com. Into the education part, you have the links to those various learning platforms. So with that, thanks for your time, and talk to you in the next episode.